This next segment of the videos covers exchanges of PP&E for non-monetary assets. Probably the most common instance of exchanging one asset for another is when we trade in an old piece of equipment for a new one. This is fairly common with vehicles, for instance. When we exchange PP&E for non-monetary assets, we take an approach similar to what we did before, but there's some twist since we're receiving assets other than cash. The recorded value of the item acquired in a non-monetary exchange is based on either the fair market value of the asset we're giving up in the exchange, that's a first choice, or the value of the asset being acquired, whichever is more clearly evident. In general, a gain is recognized at the time of the exchange whenever the fair market value of the asset being given up is greater than its net book value. And a loss is recognized at that time whenever the fair market value of the asset being given up is less than its net book value. Remember, by the way, we have to update the accumulated depreciation account for the asset being given up before we can actually record the exchange. Furthermore, if liabilities are transferred to the other party as part of the exchange, this decreases the value of the asset given up. In other words, if the old piece of equipment, in fact, we are giving that to someone else and they are assuming that liability, then in fact we would debit the related liability account. Exchanges of property raise a new issue of what's called commercial substance. A transaction has commercial substance when it puts the buyer or seller in different economic circumstances than they were in before. More specifically, the future expected cash flows from operating the asset received are different from the cash flows from operating the asset that was given up. This is it's almost always the case. Most transactions and exchanges like this have commercial substance. But there are occasions, particularly when we are the exchanges between what are called related parties, where some of those transactions may be suspect and one party may wish to create losses in order, for instance, to reduce reported income, and maybe the income tax is related to that. Perhaps in class we can talk a bit more about that, but let's move on with the examples here. Exchanges are generally assumed to have commercial substance, and transactions that lack commercial substance most often occur in exchange of similar assets, for example, one truck for a similar one. I raised the question why a company would want to engage in an exchange of cash if the cash flows are not different than before, but I'll save that discussion some for class. The basic rule is this: when an exchange lacks commercial substance, we recognize losses, but not gains. Gains would be deferred, which means we would reduce the recorded cost of the new asset by the amount of the unrecognized gain. Let's look at an example. Probably what I've just said doesn't make so much sense, but hopefully it will once we see some numbers. Here's an example of gain on disposition. Acme Corp acquired a truck valued at $8,000 by trading another truck, original cost $20,000, accumulated depreciation $15,000, plus cash of $2,000. In other words, they got this new truck valued at $8,000 and they gave up a truck with where we have under equipment, maybe under truck, we've got a $20,000 balance and then a related accumulated depreciation account with a, of course, credit balance of $15,000. What's the implied value of the truck that we're giving up? Well, practically speaking, if we're giving up an old truck plus $2,000 to acquire a new one valued at $8,000, it's evident that the old truck's value is $6,000. In other words, we will assume that these two parties, if they are that is the buyer and the seller, if they are acting objectively in their own best interest, that they're not going to give up value unnecessarily. And so we can imply the value of the truck that we're giving up by looking at the value of what we are receiving and the amount of other consideration, in this case the cash of $2,000 that we're giving up. Now to write the entry to record the acquisition, notice here we've actually got two pieces of equipment, so we have to be careful. Now notice when I say here debit equipment for new, there's not really an account title called equipment parenthesis new. This new and old designation in parentheses here are just ways of, let's say, helping us keep track of which equipment is which here. So we're debiting equipment for the $8,000, an equipment account for $8,000, representing the value of the new equipment that we're acquiring. Of course, we've got to get the equipment, the old equipment balance and the related accumulated depreciation equipment balance off of our books. So we debit accumulated depreciation equipment for $15,000. We credit equipment for $20,000. Notice again, there's no account called accumulated depreciation equipment old. It's just this is helping us designate, helping me make sure that I identify with you and that you can clearly see what balances go with the asset being given up in this case. Now we're also giving up cash of $2,000, so there's a credit to cash of $2,000. And notice once again, the gain or loss is really going to be a function of the it's going to function as a plug. In this case, the debit to equipment new and the debit to accumulated depreciation equipment old sum to $23,000. The credit to the equipment account for the old asset, $20,000, and credit to cash of $2,000 is $22,000. So the gain, so we have to record a credit here for this transaction to balance, and so that represents a gain on exchange of the equipment. Now if you go back and look at earlier notes, I said we're going to have in a transaction like this, we're going to record a gain whenever the fair market value of the asset given up exceeds its net book value. In this case, notice we had determined that the fair market value of the old asset must have been $6,000. That just was evident to us. But the net book value, that is the $20,000 minus the $15,000 accumulated depreciation, of $5,000 means that we sold the asset essentially for $1,000 more than the recorded net book value. So that's why it helps to explain why we have a gain here on this exchange. We could call this gain on disposal, gain on exchange, probably gain on sale. Doesn't tell the whole story there, but you know, a company might have only one account that it uses. Probably if you had a gain on disposal of equipment account, that would really satisfy any events where you sold the asset, where you exchanged it, or where you simply hauled it off to the back lot or gave it away to someone, where you didn't sell it or didn't receive anything. Okay, let's look now. Make sure you understand this transaction here. And notice we're going to go now to a similar situation, except that we're going to assume that the exchange lacks commercial substance. And here we go. Same information, but the only change being that this exchange lacks commercial substance. In other words, we determined that in fact the buyer and the seller were not, well, the buyer is our concern here. The buyer was really not in any significantly different circumstance after the transaction or after the exchange that it was in before. And so this was termed to be an exchange that lacks commercial substance. Well, notice here, we would still say, well, if we're giving up an asset that's worth $6,000 and receiving an asset worth $8,000, let me say it differently. If we're getting an asset worth $8,000 and giving up an asset worth $6,000 and cash of $2,000, then under the old, if this transaction has commercial substance, we record a gain. Here's the big difference when we are dealing with a transaction or recording a transaction that lacks commercial substance. Notice we will reduce, in this case, the recorded value of the new asset by the amount of the gain which is being deferred. Or in one sense it's being disallowed, but it's not, it's really being postponed, and that's really what deferred means, doesn't it? Postponed, put off in time. So notice here we've got a debit to accumulated depreciation equipment and credit to equipment. Both of those amounts correspond to the balances in the old equipment accounts. We've got this credit to cash, But notice what we're going to do. Rather than record a gain, we're going to simply record that equipment at $7,000. That is its fair market value less that $1,000 gain that we're not going to be able to report because it lacks commercial substance. Note that the $1,000 gain is deferred. It's postponed. It's put off by reducing the recorded value of the new equipment. Now you might say, well, now how is that being deferred? In other words, if we're not recording the gain now, the assumption is that if it's postponed, we're going to record that gain, that is, recognize it in a future period. How is that going to happen? Well, there's really two ways in which this is going to happen. First of all, notice we're going to be depreciating an asset with a cost, in parentheses, or let's say in quotation marks, a cost of $7,000. And so the depreciation expense on the new equipment would be less than what it would otherwise be. So it's not going to be as big a burden. It's not going to have as great expenses of depreciation associated with it throughout its life. But also, when we do actually dispose of that asset, any gain on that new equipment in the future, whenever we dispose of it, will be greater than it would otherwise have been. And any loss on that new equipment in the future will be less than it otherwise have been, because in fact we're starting with a reduced value. So that's what it means to say this gain is going to be deferred. We're not explicitly going to recognize that gain in a subsequent transaction. It's going to happen by virtue of the future accounting for that asset. Well, let's look here at a loss situation. Acme Corporation acquired a truck valued at $6,000 by trading another truck, original cost $20,000, accumulated depreciation $15,000, plus cash of $2,000. You're probably going to realize that's the same situation as before, but I've just contrived, let's say, a loss here by saying we're going to trade this asset and cash of $2,000 for a truck that's valued not at $8,000 but $6,000. So what's the implied value of the truck we're giving up? Well, once again, the same logic prevails. If we're giving up our old truck and $2,000 to acquire a new one valued at $6,000, then the old truck must be worth $4,000. So let's write the entry to record the acquisition of the new truck and the disposal of the old one, assuming the exchange has commercial substance. Well, notice here we're recording that new equipment at $6,000 value. We're getting the accumulated depreciation equipment and the equipment balance of the old asset off the books as before. We're crediting cash for $2,000. And notice the plug figure here is the $1,000 needed in the debit column, and that represents a loss on exchange of equipment or loss on disposal. Once again, note that the loss on the exchange, the $1,000, equals the fair market value of the old asset, $4,000, less its net book value of $5,000. Now, let's look at the final circumstance here. If there's a loss on the exchange, the entry is the same without regard to the issue of commercial substance. So if we said, now let's assume that same set of circumstances as the most recent case, but let's say that the exchange lacks commercial substance. Well, actually, there's no disallowance of loss. It's a disallowance of a gain in this case. That is, that the disallowance of the lack of commercial substance will require postponement or deferral of gains, but not of losses. So the transaction here is the same as we saw in the previous circumstance. Now, the next section we get into is going to cover some special conditions. That is, if the exchange lacks commercial substance and a gain results and cash is received in the exchange, some of that gain will be recognized at the time of the exchange. And now if it results in a loss, the loss is recognized as before. But I decided, rather than to add this to the video, just to stop right here and say, we'll pick up on this in class at a later time. That's all for now.